Okay, good morning, everyone, or good afternoon, depending on where you are in the world, or yeah, I guess that about covers it. My name is Serge Berger, as Dan so kindly introduced me as. I'm the founder of thestudytrader.com, and I think you made a great choice to attend this webinar series today. I know there's a lot of great speakers, and I'm, as always, honored and excited to be here. I help traders and active investors reach a level of consistent profitability that they never thought possible. Did you know that the reason why most traders are not making money is because they actually just simply overcomplicate things? That's right. Most traders actually make things much too complicated, and I think for those of you guys that are just getting started, this should be a real interesting topic for you to understand as a very core but basic but core topic that you really do have to keep it simple as far as trading and investing is concerned, or at least as far as trading and active investing is concerned. So today I'm going to show you guys a very highly profitable three-pronged trading approach that has not only made me a ton of money over the years, but has also already allowed hundreds of traders just like you to live a life of financial freedom by reaching consistent profitability. How would you like to be able to get up in the morning and not care which direction the market is heading, because you know you have a simple, trustworthy, and repeatable process that consistently keeps you on the right side of the market? Furthermore, and this might sound a little bit funny, but how would you like to be able to do this from your, let's say, beachside hotel room in Hawaii or your slope-side hotel room in the Alps? Well, that's actually a very realistic lifestyle to have if you learn to follow this straightforward three-pronged trading approach that I'm going to show you guys today. Financial freedom is what many traders aspire to, and my three-pronged trading approach has allowed me to live a wonderful life where I spend part of the year here in sunny South Florida. I just got back to, and the other part I actually spend traveling as well as in Switzerland over in Europe. Success as a trader really is not that difficult, and with the approach that I'm going to show you guys today, I know that everyone can do this. So let's get started. So just a couple of words about myself so you can sort of contextualize a little bit of this. I've been very fortunate throughout my career to be able to work both on the sell side and on the buy side of Wall Street, places like JP Morgan. And what that has allowed me to do is not only see multiple asset classes such as equities, fixed income, and various derivative markets, but also it's allowed me to work with some of the very best traders and investors in the world. And after having done that for a number of years, I'm very fortunate to now, as a nearly 20-year trading veteran, to be able to pass this knowledge on to you and my clients and my students around the world. So that's a little bit about myself, so you have a little bit of context. And with that, I think we can move on to the next slide and into the presentation. So as I said before in the introduction, I'm a big fan of just keeping it simple when it comes to trading and investing. I think it really doesn't have to be as complicated as a lot of people make it out to be. The reality is that most people do overcomplicate this, and the number one reason why they make it too complicated, or how they make it too complicated is a better way to say it, is because they look at too many conflicting data points, and that data point can be anything from economic data, too many different chart things, listen to too many people, all that kind of stuff. The reality is that most of the stuff you're going to focus on is actually noise. So you have to be able to hone in on the stuff that actually matters. So particularly these days, with social media and Twitter and Instagram and YouTubes and all that stuff that I use myself as a content provider, as a content consumer, which is the majority of people, you really have to be able to just tune in and focus on the stuff that matters. So the more straightforward your process is in trading and investing, the easier it's going to be for you to be able to actually stick with it. So let me repeat that. That's really, really important as a first really big major point here for the presentation. The more straightforward your process is, your trading and investing process, the easier it's going to be for you to be able to actually stick with your rules. And I'm sure this is resonating with some of you guys that are listening right now, where maybe you've gotten to a point where your process is too complex, or you don't have a process, which is unfortunately what 95% of people fall into. So make sure you have a process, but make sure it's straightforward. And most important, make sure it's a repeatable process. The very best professional traders that I have worked with throughout my career and I continue to work with have a very simple but a repeatable process. And it's that repeatable word here that's extremely, extremely important to take to heart. So let me add something else here. So the reality is that many traders at investment banks and hedge funds only actually focus on a handful of stocks or maybe one or two simple strategies. So if the very best traders only focus on one or two stocks or commodities or whatever, or one or two strategies, why is it that many private investors think that they need to become a jack of all trades when the pros don't even do that, right? So the key to success in this business, in my strong opinion, is that you have to become an absolute expert at one or two types of setups, okay? And then you look for those kind of setups, and we'll talk about what that means in a minute. You look for those setups to reoccur across the universe of stocks, indices, and other asset classes if you choose to do so. Okay? So good so far? So far, so good. Excuse me, it's still early morning, sort of. Let's continue. Again, I'm all about keeping it simple, and the reality is institutional traders have a simple, repeatable process. So what I'm going to show you guys today is a highly effective and repeatable three-pronged trading process that I know everyone can do because it's very straightforward. And I'm going to make a big statement here, but I've seen thousands of people come through this, and I know many, many people have walked away with this. I think it's literally going to change the way you're going to look at the financial markets once I'm done with this presentation today. Okay, so there's a lot to look forward to here. I know I'm only the first speaker, but I'm hoping your minds are still fresh so you can take it all in. Real quick exercise here, just to get a little bit of engagement, make sure you guys are waking up and so on and so forth. But I think it's an important exercise to do. So this can be a rhetorical question. You don't have to answer this out loud, but I think it's always good to get some engagement. So if you want to answer what stage you're in, but feel free to type it into the question and answer box. But I think most traders fit into one of the following three stages. If you are a beginner, you're just reading and studying, you've never actually done a trade, you are probably in stage number one. If you've done this for a few years, but you're just kind of going through the initial emotions of fear and greed, which is very normal, you're probably in stage number two. And if you've done this for a number of years, and either you're still losing money or you're not yet making as much money as you think you could or should, which quite frankly is almost the same thing, you're in stage number three. And I'm seeing a lot of number threes coming in here. And I think the great news about if you're in stage number three, and I see a lot of stage number threes coming in here, is that you've stuck it out this far, and I promise you, I've seen this after nearly, now 20 years of doing this business and 15 years of doing more sort of, engagement with other traders. I can tell you, if you have stuck it out for 3 years plus and you're still doing it, you're very, very close to making it happen. Okay, so that's the great thing about if you've done this for a number of years. Let's continue. Quickly on the agenda. So today, what I'm going to go through with you guys, I'm going to explain to you why identifying investor mood or emotions is critical to success as a trader and investor. Then I'm going to show you how to consistently find the highest probability points to buy any given stock, index, commodity, or currency for that matter. And then I'm going to tie all this together to give you the blueprint to this amazing three-pronged trading and active investing approach. Finally, as a bonus, I will reveal my absolute favorite option strategy that you can implement right away to generate monthly income. And of course, we can do a lot of questions and answers. We'll answer all your questions. I want to definitely go through with a lot of more examples, real-time examples. I'm going to ask you guys to show me some charts that you want to look at and see how well my approach is going to work on that, so you guys believe me that I'm not just cherry-picking examples here. So I hope you guys are excited. Let's do this. All right. So I'm not sure how many of you guys are familiar with candlesticks and what they are, but I'm going to give you guys a real basic entry-level definition here, which should be a good refresher for those of you guys that are already using it, and for those who don't know what it is, it should be a really good primer. So number one thing, let me say this. There are so many people out there that try to teach candlestick patterns, or people that use them, but they make it so much more complicated than it needs to be. And you guys will see here in just a minute, in just the next couple of slides, why that is. The reality is there's too many different types of candlestick patterns as defined by academics and other people out there that are trying to teach this stuff. But the reality is actually only a few of them actually matter and actually repeatedly work. So shocking as that might sound, you just want to use the ones that actually consistently work and show up on a frequent basis. Okay, so focus on the ones that work is what I'm trying to teach you here. So let's quickly go through a basic definition of what a candlestick looks like. So essentially, like anything, you can have an up or down market, right? Those are your two basic days in this case, and I should at this point say that candlesticks can be used in any time frame. Doesn't matter whether you're looking at a daily time frame or a 5-minute chart or a weekly chart or a 1-minute chart or a monthly chart. It doesn't matter. It really is completely irrelevant. What I'm going to do for today's presentation purposes to keep things uniform, I'll be focusing on the daily time frame just to keep the same time frame throughout the presentation so it doesn't get too confusing. So again, we can have two types of days. In this case, it would be a down day. You can see that would be this bar here on the left. We had an open point right here on this day for this. Let's say this was a stock. Okay, again, it could be a commodity, it could be a currency, it could be anything. So let's say the stock opened here in this day and it closed down here, right? That's your close on the day, that's your open. But on an intraday basis, we had a range where this stock traveled within that extended beyond the open to close range, right? So you see the daily high is up here, the daily low is here. Well, the opposite, of course, would be an up day. You can see the stock opened here in this case. Again, let's assume it was a stock. We have a higher close, okay? But again, an intraday range that extended beyond this open to close trading range. Okay, so that's your basic, that's your real basic, candlesticks on a chart on a very simple illustration here. Now, the most important part about this open, low, high close ratio or relationship is the daily close. Okay, or the close of that day or that time frames. Of that time frame, I should say. Okay, so it's the ratio of the high to open to close to low of that day or that bar that's important. Okay, so let's talk about something very, very important before we continue on to the real meaty bits of the presentation. The reality is that about 60% of us have an easier time understanding stuff by seeing a series of pictures as opposed to getting a number, like a sheet with a bunch of words or instructions on in written format. And this is the right brain. It's our creative brain that allows us to make more sense of things when we see a series of pictures. Now, the thing about this is that this statistic actually, this is the official sort of academic statistic. I honestly, in my own studies I've done, I think it's more like 70 to 80% of people that have an easier time learning stuff by seeing a series of pictures. Like, for example, I don't know if any of you guys have ever put together, it's like one of those IKEA furnitures, right? And you get these little instruction booklets or instruction manuals that are just, this very simple illustrations with these little guys that are putting things together. Very simple, right? But if you were just handed a bunch of words, most people have a much more difficult time to be able to follow those instructions. So, and that's the beautiful thing about candlesticks. Candlesticks are extremely visual, right? So if we can visually depict what's taking place in the market, we have a much easier time to understand what's going on, but more importantly, and most importantly, we have an easier time sticking to our risk management plan. And not sticking to our risk management plan, in other words, not sticking to our stop losses or our profit targets, is the number one reason why people are losing money in the markets. Okay? So candlesticks are superior, and the reason for that is, well, they're just superior to or much more visual, I should say, than bar or line charts. They give us a clear representation of what's taking place on the chart, not just in terms of price, but really what we're looking at here, guys, we're looking at price action as it shows us investor sentiment and investor psychology, okay? And if there's nothing else you're going to take away from today's presentation of mine, then this will be it, okay? What I do is I look at candlesticks and price action through the lens of investor sentiment and investor psychology, or you could even call that footprints of investors as well, okay? And I'll show you guys here in just a second what that really means. So a little bit more about candlesticks. Besides the fact that they just work, the reality is that the formations that we would need to look at where we have high probability setups, they're very easy to spot once you've trained your eyes a little bit, okay? So it's all about decision making without emotions. You have very defined risk, and you have very defined clear stop losses and even profit targets. So the reason I chose this picture here of this person is because you can see this person has some very, very defined risk. If he or she goes beyond this point here where it goes off the cliff, her risk goes from like 0 to 100% immediately, right? There's no lag. It goes from 0 to 100% because there's no point of no return. It's the same thing with using candlesticks in trading. As you guys will see in just 1 minute, we have very, very defined risk so that visually we can depict where the market is where we need to get out if something goes against us, and that in and of itself is a complete gold mine. And once you can grasp that and understand on a repeatable basis, which is very straightforward to do, you will literally see your profit and loss curve turn to the better overnight. Okay, that's a real aha moment that most people come away with after this presentation. So let's look at a couple types of candlesticks so you guys know what I'm kind of talking about. So here we have something called a hammer candlestick, and again, the name doesn't matter. I think that's all bogus. What's most important is what the application is and what it actually tells us through the lens of investor psychology. Okay, now each one of these 4 candles are, to me, they're all the same. I know some people make distinctions between these. I promise you, after nearly 20 years of using this kind of stuff, I think it really doesn't matter. They're all the same. To me, what's most important is that we just look at them holistically. So let's start with the one up here. This is just, they're all the same, so let's just look at this one here as a good example. Okay, this is number 1. So let's assume this was a stock. Again, this is 1 day, again, to keep the application uniform or the examples uniform throughout the presentation. Let's assume this was a stock and it had been in a downtrend for maybe the past few days, weeks, maybe even the past few months. But on this day, the stock opened and it dropped lower all the way down here. But something happened on an intraday basis and the stock reversed back up, so much so that it closed the day at the very upper end of its daily trading range. Okay, so there's 2 ways of looking at this. There's one thing I would refer to as the CNBC way, okay, or the financial television way, and this is not to knock CNBC. I'm just trying to give you an example of what the predominant language tends to be. And that's to say, well, what happened down here? Well, the stock dropped and then it reversed back higher. Well, we're off the lows, Joe. Back to you. Well, that statement, albeit true, has 0 emotions attached. And it's sad and almost somewhat pathetic, for the lack of a better term, because what happened down here is a lot of emotions. Okay, so let me show you what actually truly happened. Well, after a multi-week, let's say, downtrend, the stock opened here, but the bears who had been in charge in the stock for the past few weeks tried to push this market lower one more time to keep it down here. Well, guess what? They miserably failed to keep the market down here. There were no more sellers left. The point of maximum bearishness was reached down here in this time frame, okay? And when there are no more sellers left, there's only one thing that can happen, and that's for the stock to go higher, or at the very least to go sideways, okay? If you can understand now that the point of maximum bearishness, or no more sellers left down here, was being reached, you have a much higher probability wave to get your head around what it means that if the stock were to go back below here. Okay, so for one, if there's no more sellers down here, then the odds of the stock moving higher, or at the very least not going much lower, are extremely high. So you should have an easier time being able to enter a trade to the long side should you choose to do so. At the same time, if the market managed to break below here, that would tell you that there's enough sellers that have come back out, that this point down here is now becoming irrelevant, and the market will potentially go lower again. In other words, your last resort stop loss will turn out to be right here. Okay, let's continue and do one more candle type, and then we're going to look at a bunch of examples to really hit this home. And then I want to see a lot of examples from you guys where you want me to look at some charts in real time, and then we'll have a look at. Okay. So let's look at something called an engulfing candle. And again, the name here is entirely useless, although this actually has an applicable name in the sense that it's appropriate from what it's called. But anyway, let's look at what happened here. So we'll give you a bearish example in this case just to kind of mix it up a little bit. And what we had here is we had let's say it was a multi-week uptrend. Again, it could be multi-month uptrend, it could be multi-day uptrend. It doesn't really matter. Well, let's just say this was a stock, okay, and it had been trending higher for the past few weeks. Well, the stock came into this day, and you can see that it gapped higher, right? This is the open of the day. It gapped higher to open up here on that day. Well, what really happened is ultimately after the stock gapped higher, the stock dropped so much so intraday that it completely engulfed, hence the name, the previous day or day's price action. Now, again, we can look at this through a lens of financial television, which is we're off the highs, Joe, right? Back to you. Which again is a true statement, but there's zero emotion attached to something where that is very emotional. So again, the stock had been rallying for the past few weeks, and it gapped up on this day. Well, the bulls have been in charge for the past few weeks, and they tried their very darndest to push this market high one more time. Well, guess what? They tried to gap this market high. There were no more buyers left. There was literally zero buyers left. And when that happened, the market reversed lower, so much so that it engulfed the previous few days or days price action, and the market closed actually well lower on the day. Okay, so the fact that there were no more buyers left up here should be able to tell you that the investor psychology or the investor emotions or the bullish herd has exhausted. So the maximum bullishness has been reached. If you see this kind of price action, you should have a much easier time, and you will have an easier time because you can visually see that buyers have exhausted themselves. So your last resort stop, if you wanted to go short or if you want to sell your stock or whatever you want to do, will be right up here. Okay, and so you know that bulls have exhausted themselves, so the path of least resistance, at least for the time being, is most likely, at least sideways, most likely is going to be lower. Okay? So far, so good? Let's move on. I'm going to skip a couple charts here, a couple of slides here in the interest of time, and so we have more time to look at examples. So what we're going to do now, we're going to look at some examples. We're going to look at some charts, and I'll be quickly going through some bullet points on the right, but then we'll quickly move in and blow up these charts. So don't worry, we'll make this chart larger in just 1 second. Okay. So first example, let's look at this is the S&P 500. I'm sure all of you guys are familiar with it. It's an equity index. And what we're going to be looking at here is something called a waterfall sell-off, a strong sell-off that was followed by exhaustion selling, a strong bullish reversal, and ultimately bullish continuation buying. Okay. Let's look at the chart. This is actually the middle part of October 2014, so this is just about 2 years ago. And I don't know how many of you guys were involved in the markets at that point. I know a lot of you guys that put in stage 3 in the previous question probably were, but maybe a lot of you guys were not involved in the market. So I'm going to quickly give you a little reminder. But basically what we had take place at the time was we had a very sharp sell-off in the market that lasted for a few weeks. And ultimately in the middle part of October, the buyers, or the sellers, I should say, got very exhausted. You can see for 2 days in a row, the sellers tried their very best to push this market lower one more time. Each day, the market failed to stay at the lows and closed back in the upper end of its daily trading range. Well, on the third day, we had something called a follow-through buying day, and it was off to the races. So again, let's look at this the two ways we talked about before. Let's look at this in sort of the CNBC way. And again, to reiterate, I'm not here to make fun of CNBC. I like going on there and talking as well, but it's just the language being used in there is very much resembling what I'm telling you right now. So, the stock had been dropping. Then on these 2 days, they literally bounced off their lows. So the summary at the end of the day from your favorite financial publication will be stocks closed off their lows, right? True, but completely inaccurate in the sense that it doesn't really represent the amount of emotions involved in the market that day. What truly happened is that the sellers who had been in charge for multiple weeks tried to push this market lower, in this case 2 more times on an intraday basis. Each time they failed to keep it down, and what does that tell us? What is it telling us, guys? What did I tell you? It tells us that sellers are exhausted. Okay, there are no more sellers left down here. Otherwise, the market would have been able to push lower in this time frame. On day 3, we had a strong follow-through buying day, which scared the pants off a lot of the weak bears down here, and the market started to rip higher. Okay, so a lot of the bears started to start covering, and boom, we went higher. Maximum bearishness, if you can consistently detect maximum bearishness on the charts on a consistent, repeatable basis, you have a huge maximum bearishness and maximum bullishness, I should say, excuse me. You have a huge advantage over the rest of the market participants who don't do that. Okay, that's something I learned working for the institutional desks and also, of course, for my own for many years over time. So let's look at one more example here. This is the KBW Bank Index. also known as the BKX, which is the ticker symbol. I don't know if any of you guys are using this, but I would highly encourage you to look at this index if you're not using it already in your trading. So again, let's do the same thing. Let's go through a couple of bullet points, and then we're going to blow up the chart to look at it more closely. So what we have take place here is a bottoming process, okay, which is followed by exhaustion, selling, ultimately a strong bullish reversal, and then bullish continuation buying. Okay, so let's look at this more closely. This was actually just about 1 year ago, or I guess a year and about a month ago. Yes, or exactly 13 months ago, I think almost to the day. And I don't know if you might recall that last August, or August of 2015, I should say, to be more accurate, there was a strong sell-off in the broader market, and the banking stocks, as usual, they do participate when markets go up or down because they're an integral part of the economy and the stock markets. So the banking stocks dropped, but ultimately then they started sort of trotting sideways in a sideways shuffle type of price action. But then one of the first few trading days of October, maybe it was the 2nd of October or so, you can see that the bears, after having been in charge for, let's say a month and a half at this point, tried their very best to push this market lower one more time. You can see they tried to push it below these lows here from August. You see that? See that long candle? But you can see what happened. They failed to keep the market down here. It rallied back higher on an intraday basis. The next day, the market gapped higher, and it was off to the races. Okay? So again, let's look at those two ways that we looked at before. If we were to look at this through the lens of of CNBC, or the terminology used in financial publications or financial media, we would say that we're off the lows, Joe, back to you. Well, that's true, but most importantly, understand what really happened through the lens of investor psychology. What happened through the investor psychology is that the bears, after having tried to push this market lower, miserably failed. There were no more sellers left down here, and the next day the market gapped higher. If there are no more sellers left down here, you should see that visually, and you can see that visually by way of these candlesticks. And you know two things. You know that, number one, this is a great spot to buy because you have very well-defined risk, right? And number two, this very well-defined risk will tell you that at the very last resort stop, if this stock, or this index in this case, were to drop below the lows at this point, you definitely have to get out if you're long, okay? But most importantly, understand what this means. This tells us there are no more sellers left. If there's no more sellers left, by definition, the market, at the very least, has to go sideways. Most likely, it's going to have to go higher. So the point of maximum bearishness has been reached. There's only one thing to do, and that's for the market to start climbing, at least slowly so. Let's look at another example. This is the Spider Gold Trust, the GLD ETF. I'm sure most of you guys are familiar with this one. Okay. I saw Gary here say that he was part of this tail down here. I'm sure, I know you're not the only one, Gary. I remember getting a lot of phone calls from clients that day, from hedge funds and clients around the world that got a little bit scared. So you're not the only one. Anyway, let's move on with the Spider Gold Trust example. Again, same thing. I'm going to quickly go through the bullet points, then we'll look at the chart more closely in just a second. So what we're going to look at here is a topping process, which was followed by actually what this should read, exhaustion buying, a strong bearish reversal, and ultimately followed through selling. Okay. So let's look at this more closely. So this is the GLD ETF, and you can see that at the time here, this GLD had a very nice rally, okay, through a multi-month lens, and then started topping out here. And there's actually already a bearish candlestick formation here, but what I want to focus on, because it's much more visually obvious, okay, and we want to focus on the visually obvious stuff, is this right here. What happened here in this day is that the stock rallied on an intraday basis, but something happened, and the stock, or the ETF in this case, not a stock, it's an ETF, reversed so strongly that it actually completely engulfed the previous few trading days of price action, and the very next day it gapped down and was off to the races lower, right? So again, let's look at it those two ways that we've looked at the other charts here so far. Again, we can look at it through the lens of CNBC talk, which is we're off the highs, Joe. Back to you. We're off the highs, and we closed off the highs for the day, or we closed lower on the day. Yes, again, it's a true statement, but it's completely inaccurate in the sense that it doesn't represent the amount of emotions that were involved that day. What really happened is that the bulls, after having been in charge for multiple months and most recently here for multiple weeks, tried their very best to push this market higher one more time. Maybe they tried to push this market back up to these highs back here, right? You can see that they failed to do so. What happened is that they lost control of this game so quickly and so miserably that by day's end, not only had the stock failed the rally, but actually closed lower on the day, so much so that it completely engulfed the previous few days. Price action the next day, it was lower. So the fact that the bulls could not keep this market higher tells you that the bulls are completely exhausted. There were no more, as a failed rally attempt. If you can look at price action through the lens of investor psychology, guys, I promise you, over time and rather quickly initially, you're going to have a huge edge over the rest of the market participants because your odds of making money of emotionlessly flowing in and out of trades is going to go through the roof. Okay, you're going to become so much less of an emotional trader. You're going to be able to flow in and out of trades because you can see visually what is the price action telling us. Because price action in and of itself, if you just look at it as a price action and like a terminology, if you call this, an engulfing candle, it doesn't. There's no emotions attached to it. That's why I try not to use those terms if they're confusing. Maybe not on the surface, but that deep down below, they don't tell you anything. But if it tells you that everyone was bullish and there were no more bull buyers left, you intuitively, your psyche tells you that you can do the opposite and profit from that, and you have a much easier time starting to stick to that rule. Does that make sense so far, guys? I'd love to hear some feedback as we go through these examples. I'm sure this is pretty awesome stuff. I know a lot of you guys are probably having an aha moment here. So let's continue to do one more example. Let's just go right to the example here. This is not so important to go through the bullet points. Let's look at the chart of Hewlett-Packard here. And you can see at the time here, the stock had a down gap, and then it just basically had been trending lower for the past month and a half or so. So what actually happened is that Hewlett-Packard here, you can see down here, tried to push lower on this day one more time, right? Really tried their best. The bears, after having been in charge for the past few weeks, month and a half, tried to push the market lower one more time, but they failed to keep the market down there. What actually happened is you can see that the stock bounced off the lows and closed on the upper end of the day. The very next day, we had a very strong bullish reversal, a strong buying day. It was off to the races. Now, again, the buying day is important, and that's the confirmation, but it's important to be able to double check to make sure that this buying day actually was important, okay? And the way we do that is by looking and seeing what happened the past day or the past few days, and you can see what happened is that the bears, after having been in charge for the past few weeks, tried their very best to push the market lower, failed to keep it down here, no more sellers left, closed off the lows, so the bears failed to keep the market down, and the very next day, strong buying day, and off to the races. So if you're going to buy this stock here, you have a very, very last resort stop down here because that's where the sellers exhausted themselves previously. But also as a buying point, you understand that this is a pretty good spot, a really good spot to buy, because that the sellers have exhausted themselves, okay? So let's move on, and let's move to the 3 steps to the trade, okay? Now, unlike a lot of people that try to teach you trading and investing, I've done this for a long time, and I can tell you that it's really, really important to have an approach that forces you to understand the bigger picture. And to me, the way I identify the bigger picture is by looking at what I call the market structure. Okay, so I think you need to have an understanding of what the market structure looks like at any given point. What's the market structure? By my definition, market structure entails things like monetary policy, business cycle, and maybe even the political environment. So for example, right now, we are in an environment where there's some political uncertainty, clearly, with the election less than 1 week away, U.S. election. But from an economic business cycle perspective, arguably more importantly, we are very, very late in a cyclical expansion. Now, I think we are still in a secular bull market as far as equities are concerned, U.S. equities. But as far as the expansion goes from a cyclical aspect, I think we're overbought or extended. At the same time, from a monetary policy perspective, the Fed is trying to be hawkish here at the year end one more time. We saw what happened to the market last time around they did that. So we have a bit of a dichotomy of reality, right? The reality is that corporate top and bottom lines have been slowing for the past year and a half. That's a fact, okay, in rate of change terms. And so has economic growth. You know, same thing for job data. Everything has slowed for the most part year over year. So we are in a slowing environment, and yet the Fed is trying to hike rates. They're trying to do this for different purposes. I understand why. But the point is they're probably not going to be able to do this very long. So they may be do another one and done kind of thing. So the environment where you're in, guys, is that we're basically stuck at best in a sideways range as far as equities, because in fact we're most likely need to be fading rallies. Gets me to point number 2, okay? Which is, once you've understood the broad market structure, then you look for stocks and commodities or whatever your focus is that tend to do well, or if you want to be on the short side, that tend not to do well, right, in this type of environment, and then you make sure you focus on those to give yourself the maximum edge. And step number 3 is you then focus on those bullish, bearish reversals as I just outlined to you guys, and you make sure you follow that religiously and stick to your stop loss and your profit targets. Now, very importantly, you can actually reverse engineer this entire process, which is to say that if you came across a chart or a stock or a commodity, whatever it is, that had a very strong bullish or bearish reversal, as like we just looked at before in the examples, and we're going to look at many, many more examples here in just a minute. If you were to come across one, you can actually reverse engineer the process and then look at step number 2, make sure that this stock does fit, again, into this step 2, and that step 2 still works with step 1. Okay? So I hope you guys wrote this down. This is really, really important. Again, the big differentiator here is that a lot of people out there think you can just look at a chart without any context. I promise you, after 20 years of doing this, or nearly 20 years of doing this, you need to have context and perspective. And that only comes if you have a step number 1, which is to understand what the big picture looks like. Okay, otherwise you're going to take too many trades that are invalid, that give you low probability of making money. Make sure you understand the big picture. Now, that doesn't mean you have to read the Wall Street Journal from front to back every single day, but it does mean that you have to keep perspective. So make sure you're kind of in tune with it a little bit each day and each week. So let's look at these same charts we just looked at 1 minute ago, or a few minutes ago, and we're going to look at them through this 1, 2, 3 step process. Okay, so let's start off with the S&P 500, and you can see what took place here. So if we start with step number 1, step 2, step number 3, what we had here was, at the time, what we're looking at here is the bullish reversal I showed you guys before in the daily chart. That bullish reversal was in the middle part of October 2014. At the time, the market or the economy, U.S. economy, was still expanding moderately to slowly. The Fed was still being accommodative, i.e. somewhat dovish. So if you would have had an understanding of step number 1, the broad market structure, I mean, you saw this dip, you would have had a much easier time buying that dip once we had a confirmed bullish reversal, right? You can see that this dip, this 2014 October dip, actually took place on the chart right along the 2011 support line, okay? So if you would have had perspective from step number 1, step number 2, and you saw the bullish reversal, you would have had a much better probability of taking that trade. I remember it very clearly right here, middle of October 2014. I got my phone was going off the hook, my text message, phone message, everything was going crazy because people around the world, all my clients were trying to call me and reach me somehow, asking me, what the heck do we do? Is the market falling apart, or is this just something we need to buy? And I said, listen, guys, for one, let's give it a little bit of time, give it a few days, maybe wait for a weekly close, and then we'll see. Because right now what's taking place is that step number 1, things are still looking okay. We're still expanding. The economy the Fed remains dovish. And sure enough, by week's end, we had a strong bullish reversal. I told all my guys, listen, looks like this is going to hold. We bought, made a ton of money, and the rest is history. Okay? Let's look at the KBW Bank Index. This is the example we looked at before, the banking index. And again, let's look at this through the lens of the step 1, 2, 3 process. Okay? So if you recall, we looked at the bullish reversal that took place on the daily chart. This is the weekly chart now, okay? But at the time we looked at it on the daily chart before, and we looked at that bullish reversal that took place in, I guess it was early October of last year. And I think it was Gary who said he was part of getting sort of faked out in the trade, which is, perfectly fine. That happens. But basically, at the time, what was happening, if you had context and you understood it, is the reason the banks were rallying or about to rally and give us a strong bullish reversal was because the Fed was basically doing something they're doing again this year, which is being hawkish into year end. In other words, threatening this rate hike into year end, right? Despite the fact that the economy is actually slowing. Well, if interest rates are threatened to be rising, banking stocks at the margin tend to do well, or at least outperform, relatively speaking, the broader market. Well, if you would have understood where we are in step one, that the Fed was being hawkish into year end, and you would have seen that strong bullish reversal take place on the daily chart, as well as on the weekly chart, you would have seen that it came into a multi-year lateral support area, horizontal support area. If you would have seen all these three things in step 1 through 3, which is very straightforward, arguably, you would have had a super, super high probability to make money. We did. We noticed that trade. We took money, and it was awesome. Okay. So again, step 1, 2, 3 process, very, very important. Yes, it's very important to be able to understand the maximum bearishness and maximum bullishness, but you got to have context. If you don't have context, you're just guessing. You have to understand step number 1. Very, very important. Again, most people don't teach that, but that's also why most people's trading systems and trading methodologies don't work. Okay, and I'm not saying this to knock other people, but it's just a fact. So you have to have perspective. Okay, let's look at the gold ETF from before. We'll keep this one a little bit simpler. We're just going to look at the chart here. But if you recall that bearish reversal I showed you guys before, which took place on the weekly chart, a multi-year weekly chart took place right here. So if you would have understood that bearish reversal I showed you guys before, that was very, very, very clear, where buyers get exhausted. If that took place on the multi-year chart, it took place right at this diagonal resistance line, you would have had a much higher probability chance of taking that trade and actually sticking to your rules. And also, you would have had a very well-defined stop loss, as candlesticks do, both on the daily chart and on the weekly chart right here. Because if this GLD, this ETF, would have popped above this diagonal resistance line, you would have had a much clear signal to get a very clear signal, to get out of your short positions, or indeed maybe even buy the GLD. Okay. So we're going to skip this Hewlett Packard example in the interest of time. I want to make sure we do a lot of examples for you guys. Now, before we go to examples, and I have a ton of real-time examples actually today, since the market is open and there's really nice trading ideas I just generated yesterday, and I'm going to share them with you guys today, okay, in just a couple minutes. Before we do that, let me quickly give you guys the bonus options trading idea, or options trade strategy that I promised you at the beginning of the webinar. My favorite option strategy looks as follows. My absolute favorite option, and I've done many, many different types of options trading strategies throughout my career, is to look for vertical slopes, and most of those tend to happen in your favorite cult stock like an Amazon.com, or maybe a commodity that tends to rally or fall too sharply over time. But when a cult stock, let's call it for lack of a term, rallies too strongly, ultimately it'll take its slope into vertical overshooting mode. Okay? When that happens, you have the highest probability chance of making money on the short side. In my opinion, you have the highest probability chance of a successful trade. Okay? And here's why. When a stock like a Tesla or an Amazon.com takes a steep slope and it takes it into vertical overshooting mode, and it starts giving you a confirmed bearish reversal, like for example we're having on Amazon.com right now. Okay, I'm going to show you guys this chart. I usually don't show this live chart, but today we have the market being open. Okay, this is Amazon.com, and to me personally, by any definition, this stock has once again taken a steep slope into vertical overshooting mode. Again, that's not me making a bearish call longer term in the stock. I'm a big believer in it, but the stock has exhausted itself. Okay, so Once that happens and you have a bearish reversal take place, okay, you can see the stock has gone into vertical overshooting move in the past few months, again, the past 6 months. Once you have a confirmed bearish reversal, which we had last week after earnings, you have, in my opinion, the highest probability chance to sell out of the money call spreads for hugely juicy premiums, okay? Sometimes you can go 10, 20, 30% out of the money and sell options premium 2-3 months into the future to make beautiful income month after month looking out and planning ahead, okay? So that is, to me, is the highest probability chance that you're ever going to have, in my humble opinion, of 15 years of doing this strategy, using an option strategy. There's so many option strategies out there, and a lot of good ones, but a lot of them don't really have really good odds. This one, in my opinion, let me clarify. This one has a 90 to 95% chance of making money at any given point, okay? And it becomes all that risk managing the losers so it's a very simple strategy, okay? So also what tends to happen, by the way, is maybe I'll quickly give you this as well. When a stock goes into vertical overshooting mode, implied volatility tends to rise, okay? And the reason towards the end, and the reason for that is because market makers and smart money investors start to get a little bit more concerned. They start bidding up the implied volatility in the stock because I think ultimately it's gonna consolidate or go lower. And indeed, that is what once again happened in Amazon.com just a couple of weeks ago. Okay, does that make sense? So let's go through a couple of examples. Really quickly, the summary here before we look at examples. I'm going to give you guys some real-time trade ideas in just a second. Candles show investor footprints and emotions. So what we need to have a straightforward and repeatable process, because that's the key to consistent profits as a trader and an active investor. The three-pronged process I showed you guys today, and we're going to go through a lot of examples right now, is to understand the market structure or the market environment, then scan for technically sound stocks and commodities using within the broad market structure, and then use the step 1, 2, 3 bullish bearish reversal process to get into the trades. Okay, very straightforward, very high probability. So now I'd love for you guys to start giving me some tickers, some stocks to look at. So look for strong bullish and bearish reversals, things you want to look at. Would like to help you out right now. So just show me some tickers, and we're going to go through them with examples right now. We have like 25 minutes left to do all that. Good, a lot of things coming in. All right, so let's look at Nike. Okay, so Nike, for example, let me show you guys an example right here. Just to kind of hit it really home, this is a beautiful example. So so that's a really good example to look at. Okay, so look at Nike, for example. Look at what happened here. We had a stock that rallied very nicely in 2015, and ultimately the stock stopped going higher here towards the last quarter of 2015. Okay, and what then happened is you can see the stock failed to go higher, and failed to go higher again here a little bit later in November of last year, and then finally we came into this day right here, which was I guess just before Christmas, it looks like. Yeah, the 23rd of December 2015. Now, again, we can look at this two ways. You can see basically what happened is a failed rally. We can look at this through the lens of purely price action, okay? So the CNBC way to look at this would be like, okay, well, the stock rallied, but it closed off the highs. Again, not an untrue statement, but not something that truly reflects what actually happened that day. What really happened that day is that the market, after the bulls, after failing to push this market higher a couple times here, exhausted themselves. They tried to push the market higher one more time, miserably failed. There were no more buyers left up here, right? You guys can see that, right? No more buyers up here, no more buyers. And ultimately, the stock reversed completely lower and gapped down the next day, and the rest is history, right? The point of maximum bullishness had been reached. If there were no buyers left, the path of least resistance is at the very least sideways. Most likely it's lower, right? So you guys can see that by being able to pinpoint when a stock exhausts itself through the lens of price action, if you just forget what kind of candle this is called and just look at the price action and understand that this clearly signifies that buyers got exhausted. You have such an easier time getting in and out of a trade based on this type of formula, right? Do you guys like that? Does that make sense? Let's look at another one here, Facebook. So let's look at Facebook. Okay, so Facebook, really good example. It doesn't really matter where we look at. Let's just, for example, look at here. Okay, so let's look at the Facebook chart right here. And you guys can see that what happened here, this is actually the February lows or January lows of this year. And you can see what happened. Facebook stock dropped along with the broader market. And they came into this day, okay? And some guys are asking, what are these moving averages? These are very, very simple. 50-day moving average in yellow, 100-day moving average in blue, and the 200-day moving average in red, okay? So what happened here is you can see the stock dropped and ultimately we came into this day, which also happens to, in this case, match up with the 200-day moving average. But you can see what happened. You're welcome, Charlie. The stock failed to keep lower and close down on the day, right? And 2 days later, the stock gapped higher and it was off to the races, right? So again, what happened through the lens of investor psychology, which we can detect by looking at price action, that the stock exhausted itself. The sellers, after having been in charge for the past couple of weeks, had exhausted. There were no more sellers left. The stock gapped higher 2 days later and it was off to the races. Okay, let's go up here. Look what happened there. So the stock rallies. There was actually earnings in between here as well. Stock rallies, comes into this day, right? The stock tries to push higher one more time. The bulls tried their very best to push this market higher one more time. Failed to stay up here. Failed to stay up there, right? Exhaust themselves the very next day, reversing confirmation selling to the downside, and it was off to the races lower. So again, yes, what happened is the stock closed off the highs on the day. That's a true statement. But what really happened is that the buyers visibly exhausted themselves. There were no more buyers left. They exhausted themselves, which is confirmed the next day by follow-through selling, and it was off to the races. So you have your stop loss you can set right here if you want to go short or if you want to get out of the stock. This is a great spot to get out of the stock, right? At least for the time being. And you can just trade it lower if you want to be on the short side. Okay? Good? Cool. Okay, so let's look at NVIDIA, okay? And let's look at NVIDIA on a weekly chart, okay? So NVIDIA right now, to me, right now, there's nothing yet that's screaming like extreme bearishness yet, okay? This is continues to push higher from a trend following perspective. There's really nothing I would want to do just yet on the bear side. To me, NVIDIA on a weekly basis, this is just a look at, we can look at daily charts as well, has to close below about $68 for me to get a bearish reversal. We had exhaustion buying take place last week, okay? Right, you can see we had exhaustion buying take place last week. Oh, let me get the arrow. But we have not quite yet had confirmation selling, right? So you can see the bulls failed to keep the market higher, but we need to have confirmation selling for this to become a high probability setup. Okay? Let me give you guys one example, then we'll look at something, and then I'm going to give you guys a lot more real-time examples. One example I showed this morning with my Clubhouse members is MasterCard. Okay? Let's look at MasterCard on the daily chart to show you guys what I mean. Okay? So MasterCard, you can see what happened here. This is a stock that rallied very nicely, and then it gapped higher after earnings a few days ago. Okay, you can see that. Look what happened. Stock gapped higher after earnings. The stock exhausted itself 2 days ago, so today is Wednesday, so on Monday. Buyers no longer willing to keep the market higher. There were no more buyers left. Follow through selling yesterday, a beauty of a sell setup in my personal opinion. If you're long the stock, one could consider getting out of the stock here. If one wants to short the stock, maybe buy some puts, put spreads, whatever you want to do, short the stock, sell out of money, call spreads for income. All these things are great, or something one can do here. Okay, so let's go through. You guys have so many examples. It's really, really awesome. We have about 20 minutes left on the clock, it looks like. So let me just quickly go through something I want to go through. So I would like to offer you guys today my ultimate candlestick boot camp. And what that is an 11-part recorded video series and a 30-page ebook where you're going to learn in great detail my institutional three-pronged trading approach. It's all about teaching you a low-stress, high probability swing trading method, okay, which can be used in any time frame. You're going to learn to trade this nailing reversals. You're going to learn to nail bullish and bearish reversals by correctly reading investor sentiment and emotions using candlesticks and more. Usually this course is $247. Today, I'm going to offer you guys for just $97. So it's thesteadytrader.com/pro is where you can pick that up. I'm just going to quickly type that in. It's an 11-part recording video series. People love this, and it just really clears this thing up for people. And they, if you take this course, guys, you're literally going to see a huge aha moment. I know what I've talked about today may be a bit quick, but this is a really awesome way to start learning this stuff and really start looking at the market through the lens of investment psychology. Let's continue. What I would like to say, for one, there's a 30 money back guarantee. If you don't like it after 30 days, by all means, I don't want you $97. But I do also want to warn you, I don't think this course is for people. I don't think this course is for people who can't be patient or are in trading or investing for sort of to get some kicks and for entertainment. If you're just in it to get a trade spoon-fed to you every single day without wanting to understanding how the market works, I don't think this course is for you. I do think this course is for people who want to be able to learn how to make their own decisions, to really understand how the market works, and to finally become profitable. The reality is, guys, that most people aren't profitable because they overtrade and make things too complicated. And I want to reiterate on that point in just a moment, okay? Let me just go through a couple more things, and I want to show you something really important about that point. And I really truly mean this from the bottom of my heart. The people that don't succeed in this market overtrade, and they don't stick to the rules. You have to understand that a valid high probability trading setup in any given stock, commodity index, or currency only shows up every so often. Okay, so you have to be patient and look for the high probability setups like the ones I just showed you guys in MasterCard, for example. This to me is a high probability setup, in this case, to short the stock, or at least to sell it if you were long the stock. Okay, so let's continue. What you're going to learn in this course is, again, my institutional three-pronged trading approach. You're going to learn all variations of the bullish and bearish reversal. There's plenty more than I just showed you guys today. Obviously, we only have an hour and 15 minutes. I'm going to teach you guys how to use candlesticks to trade in the direction of the trend and against it, okay? You're not going to have to learn hundreds of candlestick patterns, absolutely not. I think that's bogus. I think you have to focus just on a few things. You're going to learn my rocket launch and gravity pull setups. These are extremely highly profitable trading setups. You're going to learn, guys, and this I should charge thousands of bucks for this alone. In this course, you're going to learn about multi-time frame analysis in confluence zones. Extremely, hugely, in my personal opinion, you cannot become a successful, profitable trader and investor over time unless you understand multi-time frame analysis in confluence zones. And I'm gonna teach you in this course how to do all that using candlesticks as well. Okay, so it's not just candlesticks, it's a whole bunch of other stuff as well. So it's a really fully encompassing course in that sense. I'm also gonna teach you guys how to properly use the following, because a lot of people don't do this right. Sideways channel breakouts, wedge or flag breakouts, lateral breakouts, and trading gaps. These are all various trading strategies that you have to learn. They're very simple, but you can use very clearly using candlesticks, okay? You can learn how to correctly use resistance and support lines. A lot of people don't do that correctly. You can learn how to correctly draw moving averages and which moving averages and which momentum oscillator to use, okay? That's all included in the course. And you can learn all about Fibonacci retracements as well in this course using candlesticks and more, okay? You're also going to learn where to set your stops. You're going to learn a sound risk management strategy. I'm going to teach you the mental aspect of trading, okay? And a little bit of money management as well, okay? So a lot of stuff included in this course. So I really strongly think that you you should take this course if you really want to start seeing your P&L curve turn upside down. Okay, now let's look at a bunch more examples. You guys have a lot of really good questions. Look at Google, okay? Then a caller wants to look at Google. All right, so Google, in my opinion, again, we can we can use multiple time frames, but to me, if we look at Google, I shared this with my Clubhouse members. And by the way, I should say, if you purchase this today, you will get a chance, if you want to, take a 1-month $7 trial of my Clubhouse membership. Okay, which is where every single morning I make a detailed video explaining people new trade ideas. I send them an email with it as well. They have a login to my website. It's thesteadytrader.com. We have members-only webinars twice a week. They get to ask questions, new trade ideas, and every single day. It's really, really awesome stuff. I shared a trade idea with them in Google last week. I said, listen, I think it's time to short it or get out for a trade. Why? Because the buyers got exhausted. Okay. Right here. Buyers got exhausted after earnings. The stock tried to rally. It failed to do so, followed through selling, and it's off to the races lower. Look at it on a weekly chart. On a weekly chart, even better. Okay, we had a confirmed fake out rally move last week, and this week we're following through to the downside. Okay, now in this case, I don't think Google's going to fall apart, but indeed there was a strong bullish reversal as defined not only by my B2 reversal indicator. By the way, if anyone's interested in my indicator, you'll get the chance to buy it if you purchase the course. You should be able to. You afforded to that. The indicator just gave me that signal last week. What else? Another one I want to look at, show you guys is someone wants to look at NE. Noble. Yeah, there's nothing in NE. It's just a straight shot to the downside. Noble. Not much to do there. Lindsay, unfortunately, I can't pull up currencies on this platform today. I apologize. Okay. Jim, did you see that on NVIDIA before, that example we did? So on NE, you need to wait for sellers to exhaust themselves. Okay. I don't see, there's nothing to do here. Okay. You really have to wait for something to take place here. Okay. Another idea, guys, another trade idea to me is taking place in also in Hasbro. There was a bearish reversal taking place, not as strong yet, but it's one worth looking at. And the other one is in Akamai, AKAM. Okay, another signal that was flashed by my B2 reversal indicator just yesterday, actually. Okay, you can see Akamai exhausted itself on the upside. You can see that right here. Okay. You can see the buyers after this was earnings, the earnings up gap, stock rallied. Buyers exhausted themselves on Monday. Okay, you can see the buyers no longer, could keep the market higher. You can see they closed the day well off the highs and then reversed it lower. So on my indicator, I had a signal that looked something like this. A down arrow that gave us a bearish confirmed sell signal yesterday. I shared it with my students. A lot of my students have this B2 reversal indicator, so if you're interested, if you want to purchase that as well, make sure you first purchase this course, and then you'll be prompted to that going forward as well if you're interested. And then finally, if you want to take a membership, a $7 membership trial for 1 month, you can do that as well. But again, you first have to purchase. The reason I do this is because I want people to first take the course and really understand this stuff, okay? It's really important because an uneducated trader is a dangerous trader for him or herself, I don't mean that in any other way. So that's one thing. Now, another one is BHI. Someone wanted to look at BHI here. BHI. Yeah, Tony is asking, does the course cover the market structure in step 2? Yeah, it's all the basic premise. The course really focuses on the technical aspect of using these candlesticks, mostly. So it's really a full encompassing course in that sense. And the step 1 stuff is something that I'm actually developing a brand new course, a really, really big one, an advanced course that's going to be coming out later on this month. That's just a bit of a heads up for those of you guys that are following me on YouTube. And I have a YouTube vlog and all that, if you guys want to follow me along there as I trade and go through my life. You can do that as well as type in my name into YouTube. BHIA confirmed bearish reversal. Megan, that is beautiful. Megan Smith was asking about the bearish reversal in BHI. This is a thing of beauty. Yes, it was flashed on my B2 reversal indicator the other day. So yes, absolutely, this is indeed a beauty of a buyer exhaustion. Let's look at what happened here. And Megan, give me a nod if you understand this as well. Now again, we can look at this through the lens of price action. What happened? Well, with the buyers exhausted, we were off the highs and we closed lower. Correct. But what really happened is that there were no more buyers left. I don't know, did BHI have earnings? Let me see, let me blend earnings in here so I can see that myself. Here we go. Nope, doesn't look like it was earnings. Anyway, it doesn't matter. It failed rally on Monday. So really, you can see there was a rally attempt, but no more buyers left up here, right? That's visibly obvious to you. So if you are long this stock, you should take profits, in my opinion. This is not financial advice, just what I'm telling you. You can visibly tell. So the biggest, nastiest, most obvious candlesticks out there, guys, are 99% of the time they're going to be your most important ones to focus on. And here's the point I want to make before, and I hope you guys are still listening. This is probably one of the most important things I'm going to say here. Let me just quickly say it now. All this trading action in here, all this sideways chop, all this crap in here, excuse the language, all this is useless. Most people do way too much trading, and I mean like dramatically too much trading in any given stock, okay? You need to start learning to focus on the high probability setups. In Baker Hughes, if I look at this chart, honestly, in my personal opinion, there was maybe two, just on this here, there's maybe 2 points I would have done anything in this stock. Number one would have been maybe on the breakout here, and number two is now. You know, you don't have to short the stock if you don't want to, but at least if you're long, get out of it right now, you know, and maybe you can buy it again lower or buy it once you have a bullish reversal again. Okay, a lot of good questions. Thanks, Gary. Glad you liked it. Oh, I see. That's the GE, right? Okay, that's the GE announcement. Exactly. Yeah. So the reason for the pop and drop was the GE announcement for the takeover. I guess was the buyout for the part of the Baker Hughes operation, something like that, right? Exactly. Yeah. Thanks, guys. Exactly. Okay. Now, so Tony, I hope I answered your question before about that. Yeah, exactly. Don't buy this stock. I mean, again, not financial advice, but just looking at this, you can see. Buyers very much exhausted. There's no reason to buy the stock right now. Okay. Someone's asking, what trading platform does the beta reversal indicator work for? The beta reversal indicator works on Thinkorswim. It works on eSignal, works on TradeStation, and NinjaTrader. What trading platform am I using? I think that's kind of irrelevant, to be honest with you. This is not a trading platform. This charting platform is eSignal. The trading platform I use multiple stuff. I use Bloomberg. I use a whole bunch of stuff. Okay. Okay. So does this make sense to you guys? And again, so make sure you take the course. It's just $97. It's a one-time payment. There's no recurring fee. Okay. You go to thesteadytrader.com/pro. Thank you, Charlie. I appreciate it. Charlie is making a very nice compliment. He's telling me the stuff is pretty good and you are very nice. Thank you. I appreciate that. I tend to be a nice guy. Yeah, I don't know. There's no point. You know, life is too short not to be nice to other people. You got to be courteous and nice and useful in life. That's sort of the basic principles I live by. But anyway, so BHI is another one. Now, a lot of you guys have other questions here. Yeah, unfortunately, I couldn't. Oh yeah, someone was asking about does it work on? Let me see, on currencies. Who was that? Who asked about currencies? Oh, Tony. You were, no, hold on. It was someone else. Oh. Aslan, are you still there? Aslan, are you still there? You asked about if this works for currency traders. Yes. The answer. Okay, so it's a resounding yes. What I'm showing you guys here has nothing to do with what the underlying asset is. Okay. What I'm showing you guys. Let me just show you. Go to the example. This is a live example, a live valid sell setup. In my opinion, as indicated by what I teach, by my B2 reversal indicator as well, that you guys can purchase if you want to. Just make sure you purchase the course first. Yes, we'll look at Apple in 1 second as well, Dinakar. Thank you, Charlie. He's also saying I'm sincere. That's great. Thank you. So this has nothing to do with the underlying asset, guys. So Fernando and Aslan, what I'm teaching you guys, and that's the whole point, I'm showing you guys the point where you understand where maximum bullishness has taken place or maximum bearishness. You can visibly tell this by looking at candlesticks. If you guys stop, if I beg you, stop looking at price action through a lens of price action. Forget it. Forget this is called a spinning top or an exhausting, whatever the heck it's called. It doesn't matter. It's useless. Look at what happened. The buyers rallied the stock. After earnings, it failed to keep up here. It visibly exhausted. The buyers failed to keep up there. The next day, yesterday, the stock confirmed selling lower. It's visible at time because there's no more buyers left. So for the most part, the odds are very high. The stock, at the very least, it's not going to go much higher from here. It could go sideways, but you have a very high probability spot here to sell the stock. So it doesn't matter where it's a stock. It doesn't matter where it's a currency. It doesn't matter if it's a commodity. It doesn't matter if it's the the amount of cheeseburgers I'm going to eat in the month of November plotted in a chart. At some point, that's going to get exhaustive. The amount of cheeseburgers I eat in the month of November, if we were to plot it by November 29th, if I eat a cheeseburger every single day this month, which is disgusting to think about, as much as I love cheeseburgers. Let's say this was the chart, the amount of cheeseburgers I'm going to eat every single day this month, and let's assume this was, and let's say on the last day of the month, on like the 30th, 31st, or whatever, on the 30th of November, I'm going to eat 2. Well, I'm probably going to be dead sick and in a hospital at this point. So you can short me buying cheeseburger at this point. It doesn't matter what it is. You can plot anything in a chart, So this is visibly telling us the buyers are getting exhausted. So is everyone now excessively grossed out about my cheeseburger analogy? But does this make sense? Yeah. So Aslan, last thing saying that he or she, I don't know, if, loves to be able to determine the market sentiment with currencies. Absolutely. Absolutely. This is this is the way to make money, in my honest opinion, in stocks and in the market in general. So again, guys, take the course. It's just $97, a one-time payment. It's an 11-part recorded video series and a 30-page ebook. You go to thesteadytrader.com/pro. Again, usually this retails for $247, but you guys can get it for just $97 today for this special offer. And I'd love to be able to have you guys on here. So any last questions? I think I have about 2 minutes left, and then we have to wrap it up here. Let me show you guys one more example, just so you guys know. Like, for example, we had a buy signal that we had in IMAX the other day. I think it was 2 weeks ago. A beautiful buy signal here. You can see the sellers exhausted themselves. Look at this. Seller exhaustion, okay. Yes, Tony. Yes, just please don't abuse that offer. Okay. I'm very sensitive to people coming in and abusing that. But yes, it's valid. Oh, Apple. Sorry. Anyway, this is a bullish reversal in IMAX. Sorry, Apple. Sorry, Apple. Okay. So in Apple, we actually had a strong bullish reversal take place here. Okay. This is something you guys will learn in the course. You're going to learn about confluence support areas and multi-time frame analysis. This is what we call confluence support. So Apple here had a strong bullish reversal and engulfing thing, which you can learn in the course. You can see how the stock rallied or fell here in early November, and then on this day, the stock or the sellers tried their very best to push it lower one more time, failed to do so. A strong bullish engulfing, and boom, off to the races. Okay. And this was also a huge confluence support area, made up of a 200-day moving average, a 50-day moving average. We had a horizontal support. Does that make sense, Dinakar? Right now, Apple, no man's land. I'm short out of money call spreads. In Apple right now. But if we get a strong bullish reversal here, I'll buy it. And in the meantime, I'll just I'll let it be. Does that make sense? Cool. Excellent, guys. All right, so perfect. So make sure you take the course. It's just $97. Thesteadytrader.com/pro. It would be awesome to have you guys on board. Thank you so much. And with that, I think I'm just about on time. Dan, I'll pass it back to you. Thank you so much for the opportunity, guys.
Awesome. Thanks very much, Serge. Great presentation.
Thank you.
I'm looking forward to trading that cheeseburger market.
Oh man, I've been out of the country for a while now, so I'm craving cheeseburgers. So I hope I didn't gross out everyone. So I'm in the market heavy for American cheeseburgers.
All right, so good. All right, so I want to let everyone know I typed in the URL there into the chat box. There have been a lot of comments and questions coming in, so it might have scrolled off the screen, so I'll type it in one more time. But if you want to take advantage of Serge's pro trading course for just $97. You can go to www. I'm going to type this in. Hold on a second. www.thesteadytrader.com/pro. And Serge, if you don't mind, one more time, just going over like what's included in that course.
Yeah, sure. Sure. So what it is, it's an 11-part recorded video series. So each video is like 15 to 30 minutes long. It depends. So and also the 30-page course guide. So I'll quickly scroll through. I'll scroll through it again. Let me just. Oh, this is the wrong thing. All right. Just quickly go back. So I'll just quickly scroll through the slides. Okay. Okay, so basically go through the institutional three-pronged trading approach. You're going to learn all the variations of the strong bullish and bearish reversals, not just the ones I showed you guys today, because within an hour and 15 minutes I can't do everything. You're going to learn how to use candlestick trade in the direction of the trend and against it. You're not going to have to learn hundreds of patterns because I just strongly don't think that's important. You're going to learn my rocket launch and gravity pull setups. These are hugely profitable bullish and bearish reversals. You're going to learn all about multi-time frame analysis, like as a concept, with or without candles, it doesn't matter. Confluence zones, okay, those are two major topics in and of themselves. Then you're going to learn all about various trading strategies from various breakouts and flag patterns, and how to use candles using all those. Because if you trade these strategies and you don't use candles, the odds of making them profitable is much lower than it should be. Okay, so I'm teaching you guys how to use this stuff in and of itself, and then how to use candles using these strategies. Resistance support lines, how to use that stuff, and moving averages and Fibonacci all in with candlesticks. Okay, because the combination of using candlesticks and all this stuff together gets you super high probability trades. But if you don't use this stuff together, if you use single factor models, I guess that's what I'm trying to tell you. If you use a single factor model, if all you do is use moving average or you use some sort of resistance line or something like that, and that's all you do, you have a low probability trading setup. You have to use the confluence of these things happening, okay? And that's what this course is all about, teaching this kind of stuff. You're going to learn also how to set your stops, risk management strategies, some money management, and it's just a jam-packed full of stuff. Again, it's 11 parts, 15 to 30 minutes each video, and the 30-page ebook.